Okay, let us shift focus back to the broader markets now. Invite Jigar Mistry, co-founder of Buoyant Capital, to discuss the market fundamentals and the road ahead. Jigar, good morning and thanks for joining in. The big debate really now is whether the PSU bank rally that we've seen is something that can extend itself. Which side of the camp do you belong to?
Good morning, Sonia. I think that's a big debate raging on. If you put some context to it, it becomes a very interesting story. So, what used to happen is that private sort of banks used to run first, then PSEs used to rally, but by the time interest rate cycles would catch up, and therefore you will start seeing the NPAs cycle pick up as well, and then, it all used to come down a big train. The story this time around could be a little bit different because, see, prior to 2015 and post 2015, I think we are in two different banking sector worlds. Prior to 2015, if a corporate, received a large banking loan, it was somehow the bank's problem. And bank, if they didn't pay up, then banks used several evergreening mechanisms. I've lost count on the number of acronyms that were coined up at that time. And banks used to sort of keep evergreening that loan so that, they could not show it as an NPA. Post 2015, with Raghuram Rajan, doing the AQR, after that, basically, the IBC code was also launched after a few years. And then, the whole pile-up of debt that happened, that essentially has subsided over the past 3 or 4 years. And, banking balance sheets are the cleanest that at least I have seen in the past 2 decades. KV Kamath says the best in 5 decades, so we can take his word for it. But what this also means is that with the credit growth rising, you are actually not really looking at the NPA cycle follow. And if that were to happen, because last 2 or 3 years, the incremental lending has either been to governments or to the retail, and both of them are unlikely to blow up at the same time. In that scenario, people used to buy ICICI and HDFCs of the world to start with, and then SBI at a certain point in time was available at 0.3 times book. So, that got re-rated to 1 time. And with SBI's success, we are likely to see a lot of these PSU banks carry in its footsteps. One point of demarcation I would, however, make here is that with SBI, even when the corporate balance sheets were growing up, if you looked at the retail delinquencies of SBI for the past 10 years, right, they were actually better than HDFC Bank and ICICI Bank also. Now, if your base case was at that point in time that, look, the corporate loans are NPA is not going to happen, then, it did make sense to re-rate SBI and, ride through that stock. But when we are talking of a PSU bank rally now, the look through into their books of accounts is very, very difficult. And it makes increasingly difficult for one to take a call on the credit cycle of those individual banks. So we were sort of owners of Canara Bank when it was in the 100 handle, 108 or something. But at 300 something, at close to 1 time book, ROE is not reaching 12-13%, ROA is not reaching 1% plus. It's a little difficult to make a case of a serious re-rating from here on. So we are not saying that, it will be a rough ride again, because, nothing sort of takes the wind out of a rally, like a NPA cycle brewing up. So that in absence of that happening, you might see the sort of share price performance mimic the earnings growth that you have seen. But my view is that a large part of the re-rating has broadly been done.
Okay, large part of the PSU banking re-rating is done. What could be the extent of the credit growth slowdown? Because you made that point that the deposit growth has not kept pace. If the banks continue to get lesser deposits, they will have less amount to lend, right? How does this typically play out? Will they? Do you think they expect? Yeah, hi. Do you think they will have to tap the markets? Is that what we should expect as the course goes on?
Yeah, good morning, Rima. So no, tapping the market won't be an option because you need to maintain a CD ratio, and therefore deposit growth needs to come through. Now, in absence, just to put the statistic, the deposit growth is at, the deposit growth minus the credit growth is at minus 8.8%, which is the lowest we have seen over the past 2 decades. Now, you need the deposits in order to fund the credit growth. And in absence of that happening, a large part of banks who are sitting on excess SLR, statutory liquidity ratio, might have to sort of wind those down in order to fund the credit growth. But imagine the consequence of that happening. If you go and sell your GSEC paper in the market at the time when there's a record government borrowing program going up, the RBI will have to come and sterilize the liquidity in the system by doing OMOs. Otherwise, the yield will just shoot through the roof, and that will have another unintended consequences. So I think for the larger banks, this is one number that at least we are closely watching out for. The deposit growth needs to keep pace with the credit growth. A lot of banks have been reporting numbers. For the smaller banks, it is in upwards of 20% handle. For the smaller banks, it is still a good double-digit healthy growth. So my sense is that, one part of the re-rating, 2022, if I break down the year, 50% of incremental Nifty profits was driven by banking profits. Right, 2021, if you remember, the same thing happened with commodity companies. So with banking sector profits coming through, the re-rating largely happening, we are at almost all-time highs on the bank index, the Nifty bank index, and the re-rating through. I think this is an incremental number we would want to watch out for before we continue our bullish stance on these names.
Okay, got that. Jigar, good morning. The next big cue for our markets is the earnings season, which starts in around a week from now. We'll have all of the IT names go first. What is the kind of growth that you're penciling in for this quarter? And also for the full year, what is the kind of EPS growth that you're looking at?
Yes, good morning, Pavitra. Yes, so if you look at 2022, India was one of those shining places where the earnings cuts were moderate. Earlier, analysts were looking at 20% growth. That's now moderated to 12. But look at what Hong Kong was down 25%, China was down 30%. So it was, this shining bright spot where everybody could, keep their sort of places intact. Going forward, I think the financials earning in absence of NPA cycle brewing up will continue to be resilient, right? You won't see a lot of loan loss provisions, which were exceedingly high in the year 2020, and those sort of coming back, but you will continue to see a reasonable clip in terms of earnings growth. And that drove maybe 50% of earnings last year. This year, it could be slightly lesser, but, growth nonetheless. If I look at analyst estimates, they're looking at, I think, 12% including financials, 5-6% excluding financials, 20% in 2024. So the next year. So earnings growth, continues to remain reasonably okay, compared especially to where the rest of the world is. IT still remains to be seen. See, this quarter, our sense is that because of the cross-currency wins, you will likely see margins continuing to be maintained. Demand outlook is not, typically great, but the margin guidance that most of these companies have given will be met largely because of the cross-currency headwinds. I think so. In terms of reported earnings per se, I don't think there is a big disappointment in store.
Okay, no big disappointment. And you're saying the large cap IT names, right?
Yes.
Okay, got that. Since we're talking digital disruption, let's talk also about the new age tech companies. We've had a slew of exits, from a lot of these prominent names like Zomato. But profitability is picking up for many of these names, whether it's Nykaa, Zomato, even, PB Fintech. What do you do here? Do you sort of take the plunge and buy into these names, or do you keep away entirely?
So we have not sort of bought into a lot of these names since August 2020. So since their listing, I think one of the predominant views that we have held is that these are not really a play as much on Indian consumerism as much as they are a play on the US 10-year treasury rate, right? Because when you take a longer dated, cash flow stream of a business, let's say, which is a loss-making company, say Netflix, for example, and that's making losses for the first 15 years, and then it starts making profit. Now, when you discount a cash flow stream like this at a 0.25% of US free cash flow, a US risk-free rate, then the number that you get is dramatically different from when you start discounting at 3 or 4%. So the time to buy a lot of these businesses is when you think the sort of rate cycle is done with. valuations you can't really comprehend in absence of any profitability, and you can concoct, price to sales or price to footfalls, those sort of valuation multiples. But unless the cycle appears to have been peaked, there is little sort of point in buying a lot of this loss-making ultra-high duration assets, which how we call it. The right to win, I think, within the names that you mentioned, PB FinTech is one such business which we have traditionally been interested in. But there again, the online portal that the government and IRDI is planning to launch, we don't really know the impact that has on PB FinTech's model. So the only thing we are watching now is let's say the Bloomberg dot plot versus what the Fed dot plot is in terms of earnings rate peak. Everybody agrees that the next couple of meets, earnings rates should rise, and then it should, be stable around that. But what the Bloomberg estimate seems to suggest that there is an immediate taper, whereas what the Fed seems to suggest that there is a prolonged period of flatness before
Jigar,
the rate starts falling again.
That point is taken, the dissonance between what the Fed has to say and what the bond markets are interpreting, and something has got to give. But we're out of time right now. Thank you very much for joining in. We need to cut across to the